If sales are growing but cash feels tight, your financial statements already know why. Many businesses grow revenue and still struggle. Why? Because revenue alone doesn't show health. Even if sales increase every month, you still can run out of cash. So check your receivables. Financial statements are warning systems. If you understand them, you make calmer, smarter decisions. In the next few minutes, I will show you exactly where to look and what most people miss. The three financial statements. Think of these as three views of the business. The income statement shows performance over time. The balance sheet shows what the business owns and owes at one moment. Cash flow shows how money moves in and out. When you use all three together, you see the full picture. Income statement: revenue minus expenses equals profit. Gross profit shows how well the core business works. Net profit shows the overall result. If revenue grows but profit falls, costs are increasing. That's why changes in numbers matter most. The balance sheet answers one question: is the business stable? Cash and receivables show short term strength. Liabilities show what the business owes. If short term debts grow faster than short term assets, pressure increases. Small gaps today can become big problems later. Smart owners watch this closely. A business can show profit and still run out of cash. Cash flow shows the real situation. Operating cash flow shows if daily operations bring in real money. If growth needs more cash than the business produces, expansion can create pressure. Always keep an eye on cash. You don't need many ratios, just a few important ones. The current ratio shows if a business can pay short term bills. Gross margin shows how efficiently it makes money. Debt to equity shows how much debt it uses. Net margin shows the overall profit. These numbers make complex information easy to understand. One number is not enough. You need to look at the trend. Trends show what is really happening. Vertical analysis means comparing numbers to total sales. For example, how much of your revenue goes to marketing. Horizontal analysis means comparing numbers over time. For example, are costs increasing faster than sales? Some patterns mean you should pay attention. If debt is rising and margins are falling, that's a warning. If revenue is growing but cash flow is negative, that's also a warning. These are not reasons to panic, they are signals to look closer. Early awareness helps protect the business. Follow a simple process. First, gather the financial statements. Next, compare different periods. Then, analyze key ratios. Look for red flags. Finally, connect numbers together. If profit drops, does cash drop too? If debt increases, does equity shrink? When you think this way, financial statements stop being reports and become decision making tools. Thank you very much.